Good afternoon and welcome to the annual Norman A. Sugarman Tax Lecture. I'm Jonathan Adler, professor here at Case Western and director of the Center for Business Law and Regulation. The center was founded in 2003 to help prepare our students to be leaders in areas of business law, to sponsor research on the intersection of business law and regulation, as well as to promote public education about these same issues. One of the programs that the center inherited is this lecture, which long predates the foundation of the creation of the center in 2003. The center sponsors a wide range of programs and conferences. Most recently, this past Friday, we hosted a conference on the case of Stonebridge Investment Partners versus Scientific Atlanta, a case that was argued before the Supreme Court coincidentally this morning on whether or not there is liability, third parties can be held liable in securities fraud class actions. On the Securities Act, it's a very important securities law case, and for those that are interested, there is more information on the case and an archived webcast on the center's website. The Norman A. Sugarman Tax Lecture was established in 1976 by a generous gift from Norman Sugarman, who is a distinguished alumnus of the law school. He was a member of the class of 1940. He graduated first in his class and was elected to the Order of the Coif that year, and subsequently worked both with the IRS and at the firm of Baker and Hostetler. And we certainly appreciated the gift that allowed for the creation of this lecture. This year, to speak on the subject of temporary effect legislation and fiscal responsibility, we are very pleased and honored to have as our guest Professor George Yin, who is the Edwin S. Cohen Distinguished Professor of Law and Taxation and Class of 1966 Research Professor at the University of Virginia. Professor Yin has taught at a wide range of, or quite a few universities and law schools. He's taught at the University of Florida and visited at New York University, the University of Pennsylvania, and BYU. Among other things, from 2003 to 2005, he was Chief of Staff to the Joint Committee on Taxation, which, for those of you that are not aware, is quite possibly one of the single most important tax policy jobs in the federal government. The Joint Committee on Taxation is incredibly important in the development of tax policy within Congress. He was also previously tax counsel for the Senate Finance Committee. So it is really a treat to have Professor Yin here today to speak on temporary effect legislation and fiscal responsibility. This is obviously an important topic, as Congress seems very interested to maintain the practice of adopting tax and other legislation that only has that is only temporary. And with no further ado, I'll give you Professor Yin.
Thank you very much, Professor Adler. That was very generous introduction. It's a privilege for me to be here today to speak with you in honor of this lecture of one of your more distinguished graduates, Norm Sugarman. I didn't have the privilege of knowing Mr. Sugarman, but in reading his biographical achievements, one thing certainly that jumped out at me was the fact that when he graduated from this class as the top student in the class, his first job after law school was working for the federal government. I suspect that in law schools today, that would be an unusual career choice for someone of that distinguished achievement. I have had the privilege on two important occasions to be a public servant for the federal government, and I will say that both as a personal matter and as a professional matter, it was an extremely rewarding experience in each time, and I would encourage you at some point in your careers to think about working in the public service. It's really quite a worthwhile endeavor. Should the United States enact more temporary laws? Most observers would probably answer that question in the negative, after taking into account the need for stability and predictability. They might see a role for temporary laws if the policy objective is particularly uncertain or controversial, And an example in recent times might be something like the Patriot Act. But these cases, I think, for most people would be clearly exceptions to the general rule. In my talk today, I'm going to take the opposite position and argue in favor of more temporary laws for at least the broad swath of federal legislation dealing with taxes and spending. My principal reason is fiscal responsibility, a view which is directly at odds with the position of many critics of the recent passage of temporary tax cuts. But I will also briefly touch on other policy reasons why temporary legislation, or its close cousin, temporary effect legislation, which I define as laws whose budget effect is of only a limited duration, may not be as troubling as first feared. My talk is organized as follows. First, I will provide a little background about the congressional process of approving tax and spending legislation. Understanding this background is key to appreciating my central thesis that the enactment of temporary effect legislation, but not permanent legislation, facilitates fiscal responsibility. I will explain my thesis principally through an example involving two familiar federal programs. Finally, I will discuss a few non-budget related issues concerning this choice of a law's duration. When the Congress decides which federal programs to support in a given year, it faces a task not unlike the one children encounter when they walk into their favorite candy store. So many choices, so little time and money. Most spending programs are approved on an annual basis, which means that this decision-making process essentially repeats itself year after year. An important class of spending programs, however, generally referred to as entitlement programs, is approved on a permanent basis. Of course, nothing is truly permanent in life or in Washington, D.C. Any law can be subsequently modified or repealed by Congress, including a law establishing a permanent entitlement program. But unless and until that happens, the law continues in effect, and people who are eligible for the benefits of the law continue to receive them. In that sense, the difference between permanent and temporary effect legislation is simply the default rule applicable to the law's duration. Permanent legislation continues in effect until changed or terminated by congressional action, whereas temporary effect legislation expires unless extended by such action. Up until recently, almost all tax programs were approved on a permanent basis. An example would be the home mortgage interest deduction, presumably approved to encourage and subsidize home ownership. Because the deduction is permanent, unless the law is changed, you will be entitled to deduct the interest on your future home mortgages. For over 30 years, budget law has required Congress to keep track of the cost of new spending and tax programs it approves each year. The purpose is not exactly the same as household budgeting, because Congress, of course, has budgetary options not available to most households. Congress can, for example, borrow to pay for the cost of a new program and pass on that IOU to future generations of Americans. Instead, the budget law requirement tries to accomplish at least two other things. First, it potentially enables Congress to make smarter decisions. Is this candy bar really worth twice as much as some other item in the store? Second, it allows the public to scrutinize what Congress has done to make sure that the legislature's priorities and choices are consistent with its own. The cost of proposed new spending and tax programs is the difference between the amount of government revenues or outlays that would occur with the program and the amount that would occur without the program. The latter amount is known as the baseline, It is determined by overlaying onto current law the economic and other variables that are projected to occur over the budget period being considered. Thus, for example, the baseline cost of a tax program, such as the credit for research and development expenditures, the R&D credit, is determined by applying the terms of current law to estimates of the expected amount and timing of expenditures qualifying for the credit, the tax situations of the taxpayers eligible to claim the credit, the likely participation rates of those taxpayers in the program, and other factors. In addition, baseline estimates are of current law, which includes scheduled changes in the law. Baseline estimates therefore generally assume that expirations of temporary law will take place as scheduled. The estimation process is then repeated, but under the assumption that current law is modified by the new legislation being considered. The repeat process does not simply apply the terms of the modified law to the same assumptions incorporated into the baseline. Rather, the estimated budget consequences of the law as modified take into account the anticipated microeconomic behavioral responses to the modification. For example, if the proposed change in the law is to double the rate of the R&D credit, the estimator might anticipate a higher participation rate than is used in the baseline, an increase in the amount of qualifying expenditures, or other changes. The difference between the budget consequences of the law with and without the proposed modification is the cost or the revenue estimate of the proposal. The estimates are presented as specific dollar figures for each of a finite number of fiscal years into the future, termed the budget window. In general, the budget window has consisted of 10 fiscal years. The estimates represent the expected cash flow changes to the government, that is, the changed number of dollars estimated to flow either into or out of the government during a particular fiscal year as a result of the legislation being considered. With this little background, let me now try to explain why increased use of temporary effect legislation, but not permanent legislation, facilitates greater fiscal responsibility. The budget law typically places some type of restraint on Congress regarding the total amount that may be spent during any particular budget window period. For example, some of you may be familiar with the fact that Congress recently revived the so-called pay-as-you-go or pay-go rule, which in effect provides that the net 10-year cost of certain programs approved by Congress cannot be greater than zero. In other words, if Congress were to pass a tax cut this year, thereby reducing the amount of taxes someone would otherwise have to pay, Congress would be forced to pass a tax increase on someone else or a law reducing some government spending in order to offset the cost of the tax cut. Importantly, all of these costs are determined only for the budget window period, typically 10 years. It is natural, therefore, to focus on whether legislative practices and budget accounting rules result in an accurate measurement of costs within the window period. Supporters of legislation have long used various techniques to try to reduce the cost of legislation within the window period. One technique is to delay the starting effect of legislation to late in the window period or gradually phase in that effect. Because this technique has the potential disadvantage of delaying the realization of benefits produced by the legislation, lawmakers sometimes employ an alternate technique of allowing the legislation to be immediately effective, but then terminating or sunsetting its effect prior to the end of the budget window period. By using either or both of these two techniques, supporters can reduce the estimated cost of legislation to just a fraction of what it would have been estimated to cost had the legislation been in effect throughout the budget window period. I had a handout for this lecture, and I hope you all have a copy of the handout. If you do, if you could turn to that, it's a table, or it's one sheet of paper which has 3 tables, and I'd like you to look at table 1. Does everyone have a copy of the handout? Okay. If you look at table 1, table 1 illustrates the point I've been trying to make here, which is that that the cost of legislation is estimated over the budget window period, which is typically 10 years. And what table 1 shows you illustrates a number of ways in which the 10-year cost can be manipulated within the political process to reduce the cost and thereby potentially to facilitate enactment of the law. Here, the proposal is, I'm imagining, a piece of legislation that is estimated to cost $40 billion a year for each of the first 10 years. And you see that in line 1, if the Congress simply in year 1 or actually in year 0 enacted this law on a permanent basis, then the official 10-year cost of the legislation would be a total of $400 billion over the 10-year period. Now, supporters of the legislation might well look at that figure and say, well, gee, that's too costly, and that's not going to gain a majority of votes in Congress because of the cost. So is there a way that we can reduce the cost of the legislation? And lines 2 through 5 illustrate 4 very common ways in which Congress does and for many years has promoted legislation in order to reduce the cost. Line 2 gives you an example of a gradual phase-in provision. Notice that in line 2, in the first year, the estimated cost of the program is only $4 billion instead of 40, meaning that just a small fraction of the program has been put into effect in year 1. Gradually, over the 10-year period, the program is fully phased in, so that you notice by year 10, the estimated cost is the full $40 billion. But of course, by doing that, the total amount over the 10-year period has now been reduced to a mere quote-unquote, $220 billion, or just slightly over half of the estimated 400. Line 3 shows you another technique where what the proposal is simply to delay putting the proposal into effect until year 6. So you notice in years 1 through 5, there's no cost whatsoever because there's no program. But then in year 6, it's fully put into effect at $40 billion, and therefore the total cost over the remaining 5 years in the period is now $200 billion instead of $400. Now, as I indicated, the options in line 2 and line 3 are not necessarily that popular, mainly because if you are a supporter of this program and if you are a member of Congress who is pushing this program because you have various constituents who are behind it and stand to benefit from it, you don't have much to show your constituents in those first few years. In the case of line 3, of course, you have absolutely nothing to show your constituents in the first 5 years. In the case of line 2, you have just a very small fraction of the program in those early years. And so an alternate technique that's developed is in line 4. Here, the program is fully put into effect in year 1, therefore having a $40 billion cost in year 1, but it's simply terminated or sunset at the end of year 5. And so that beginning in year 6 through 10, you notice there's no cost now, and therefore the total 10-year cost is only $200 billion. And finally, in line 5, I've just given you a combination of techniques, and again, these techniques are used widely. In year 5, I give you an example of a proposal which first there's a delayed effective date until year 4, so there's no cost in the first 3 years. Beginning in year 4, there's just a small fraction of the program is put into effect, so it only costs $4 billion. It's gradually fully phased in by year 7 when the cost is $40 billion. And then after year 7, the program is sunset or terminated, in which case there's no further cost in years 8 through 10. And you notice the totals now, we've gotten it down to $80 billion, or just 1/5 of what the total cost would have been on line 1. So this illustrates just in very simple fashion a number of the techniques that Congress has used over the years to try to reduce this so-called official 10-year budget cost of proposed legislation. Although these techniques have been used for a number of years, the extent and frequency of their use in the tax area grew dramatically beginning in 2001. In that year, Congress approved major tax cut legislation, virtually all of whose provisions expired 9 months prior to the end of the budget window period. In addition, it phased in or delayed the effect of many of the provisions. These two steps significantly reduced the estimated total cost of the legislation over the budget window. A good example is the repeal of the estate tax included as part of the 2001 legislation. Due to the very gradual phase-in of the repeal and the sunset of the repeal as of December 31, 2010, the provision was estimated to cost about $138 billion over the 10-year budget window period, or roughly 1/5 of the estimated cost had the repeal been in effect throughout the period. So you might think of the estate tax as an example of line 5 on my table 1, where you've used a variety of techniques to reduce the official cost to barely 1/5 of what the total cost would have been had the provision been in effect throughout the period. Much the same occurred in 2003 when Congress passed another major tax cut. In that year, the President proposed some important tax law revisions, including a change in the taxation of dividend income, which were estimated to cost over $700 billion during the applicable 10-year budget window period. Congressional consideration of the President's proposal, however, resulted in an agreement to pass tax cuts costing no more than $350 billion over 10 years, or about half of what the President proposed to spend. Instead of simply leaving out about half of the President's proposals, or making the tax cuts roughly half as deep, what Congress did in 2003 instead was to turn to delayed effective dates, phase-ins, and sunsets to pass almost all of the President's package while still complying with the tighter budgetary constraints. These practices have been sharply criticized by many analysts. The basic thrust of the criticism is that the practices enabled the Bush administration and congressional supporters to hide the true budgetary cost of the policy changes, and thereby to avoid the constraints imposed by the budget rules. As one observer stated, the, quote, Enron-style accounting, which caused the, quote, official budget projections to be universally seen as unreliable and even fraudulent, the 2003 bill's true cost will be close to double its official cost, close quote. To these critics, what was done was like replacing $5 price tags in that candy store with $2 ones, thereby allowing a child to buy more candy no matter what the budget constraint. To prevent these misrepresentations, some have suggested barring the practice of phasing in or sunsetting legislation in certain circumstances, or estimating the costs of legislation with such features as if the legislation were in effect throughout the budget window period. Another idea is to impose a 60-vote requirement in the Senate before certain temporary tax cuts could be considered by that body. Critics are surely correct that the motivation behind many of the delayed effective dates, phase-ins, and sunsets of recent tax legislation has been a desire to shrink the cost of legislation that is taken into account for budget purposes. Since budget rules provide consequences that depend upon the, quote, official cost, close quote, of legislation, political advantage can be gained by manipulating this amount. For the same reason, as we have seen, opponents of the legislation have generally focused on the same amount. But from the broader perspective of promoting greater fiscal responsibility, which is the goal of the congressional budget rules, both proponents and opponents of the recent legislation have overlooked the real budgetary impact of the legislative practices. The budget process should provide a mechanism that conveys to lawmakers the true cost of their legislative activity before they act. As I have said, this information not only enables lawmakers to make more informed decisions, but also permits the public to hold lawmakers accountable for the choices that they make. But the true cost of legislation is not necessarily its official cost. Rather, the true cost includes the budgetary consequences of the legislation throughout the period the legislation remains in effect. If that period extends beyond the end of the budget window period, then some of the true cost will not be accounted for at all in the budgetary process. Lawmakers will never have to face this cost and address whatever political or other ramifications arise as a result of it. In contrast, if the effect of legislation does not extend beyond the end of the budget window period, then barring estimation error, the true cost of the legislation is the official cost and is fully taken into account in the budget process. Lawmakers who pass such legislation do so only after internalizing fully the budgetary consequences of the legislation. These observations mean that, at least from the standpoint of promoting fiscal responsibility, legislation whose effect extends beyond the end of the budget window period, such as permanent legislation, should generally be disfavored, whereas legislation whose effect ends no later than the end of the budget period, such as temporary effect legislation, should generally be favored. An example comparing repeal of the estate tax with enactment of the Medicare prescription drug legislation illustrates this principle. As noted, repeal of the estate tax was included as part of the 2001 Tax Act and explicitly made a temporary measure. The law very gradually phased out the tax over the budget window period until 2010, when it completely repealed the tax. The law then revived the tax and returned it to its pre-2001 state beginning on January 1, 2011. The very slow phase-out of the tax, as well as the sunset of full repeal at the end of 2010, resulted in a significant reduction in the official 10-year cost of the change. Critics have pointed to the design of this change, including its early sunset, as one of the most egregious enacted in recent years. Enactment of the Medicare drug legislation in 2003 also presented some budget issues. Early on, the President and congressional supporters agreed that this effort should cost no more than $400 billion over the 10-year budget window. To fit within that constraint, many changes were made to the final legislation, including the use of delayed effect and phase-in provisions. Importantly, however, unlike most of the tax laws passed in 2001 and 2003, the effect of the new Medicare drug law was not sunset. Rather, it was enacted as a permanent change in the law. As it turns out, much controversy surrounded the CBO's $400 billion 10-year cost estimate of the final Medicare legislation. Shortly after enactment, for example, it was alleged that the Bush administration had withheld information from the Congress that would have shown that the estimated cost of the bill to be over $100 billion more than CBO's estimate. But the inaccuracy, if any, of the official cost estimate pales in significance to the real budgetary implications of this legislation. The true cost of the new Medicare law meaning the present value of all future costs obligated by the new program, has been estimated by the Medicare trustees to be $21.1 trillion. Thus, we see that enactment of the Medicare law represented a huge new financial commitment by the government. The 10-year official cost of the legislation, with or without the correction, represented less than 3% of the full budgetary consequences of the congressional action. Therefore, the budget process, which is intended to provide information to the Congress to make responsible choices about the nation's priorities, and to the public to be able to scrutinize those choices effectively, failed in the case of the Medicare legislation. Contrast the case of estate tax repeal. Because of its sunset prior to the end of the budget window, the true cost of this change is equivalent to the official cost, barring estimation error. Congress therefore acted with full knowledge of the law's budgetary implications and subjected itself to full scrutiny from the public for making the choice that it made. Because estimating baselines take termination dates seriously, Congress will be confronted with additional costs should it decide to extend the Schedule 2010 repeal beyond that time. And assuming that any extension does not continue in effect beyond the budget window period at the time of the extension, Congress will again be presented with an official cost estimate equal to the true cost. If I could ask you to turn back to the handout and turn now to Table 2. Table 2 tries to illustrate this last point that I'm trying to make. Table 2 shows 4 ways in which the Medicare law could have been put into effect. The first line, permanent legislation, was in fact the way that it was put into effect. And you notice that in the next column it shows the official 10-year cost was estimated at $400 billion. The other 3 lines are hypothetical other ways that the law could have been put into effect but was not. And the key point of the other 3 choices is each of those other 3 choices represents a form of temporary legislation, either expiring at the end of year 10, at the end of year 5, or some combination. Notice if you look at the next column, you see the varying amounts in the 10-year official cost, so that second column, the official 10-year cost, is comparable to the far right-hand column of Table 1 that we went through just a moment ago, where depending upon which of these various techniques is utilized, the official 10-year cost can be reduced to something, in one instance, much less than the $400 billion of the full 10-year cost. Again, the debate in Washington, for the most part, has focused on that second column. That is, to what extent do the legislative practices present an accurate representation of the official 10-year cost? And the critics have been very critical of the approaches that have reduced that $400 billion figure to something less than $400 billion. Now, my point, however, is to say both the opponents and proponents of the legislation are missing the point. The point is to look at the far right-hand column of Table 2. That's the important column. That's the column that represents what I refer to as unaccounted for costs. That's the column that represents the costs that that the legislation represents that are not presented in the budget process. Another way of thinking about it is that what Congress did in 2003 was they passed a law that has a present value cost of over $20 trillion, and yet no single member of Congress is on record as having done that. No single member of Congress has to go up for re-election and face an opponent who is going to say, why did you commit government resources to a $20 trillion program? That simply is not on the record, because what is on the record is simply approval of a program which has the official 10-year cost, which you can see is a mere $400 billion. The key to me is to look at that far right-hand column and notice that all of the temporary options, lines 2 through 4, have an unaccounted for cost of 0. And the reason for that simply is that by terminating the legislation within the budget window period, there is no cost outside of the budget window period or after the first 10 years, again, barring estimation error. Another way of thinking about it is if you go back to the example of the $5 price tags that critics were saying you've replaced them with these $2 ones and therefore you've allowed children to buy more candy. What they've overlooked is that in fact the $5 tag is the inaccurate or misrepresented value. What the $5 tag says in effect is it's the cost of paying for, say, a piece of candy for 1 year, whereas what the child is getting is in effect a lifetime supply of candy for that $5. The $2 price tag, in contrast, provides the child with a slightly smaller piece of candy and just for 1 year. And so the $2 tag is a more accurate representation of the cost. The $5 tag is the inaccurate one. Now, I know some of you at this point are probably thinking, well, you know, $20 trillion, I mean, this is ridiculous, right? And surely at some point, Congress will realize that. That is, before the $20 trillion price tag actually comes due, because after all, these are costs over a many long period and into the indefinite future, and it's the present value of those costs. Congress will wake up and will come to its senses and will say, we don't have the wherewithal to pay for all of these things, and so we'll have to change the law. And maybe we'll repeal that law, or maybe we'll reduce it. And so in either event, some of you may be thinking, well, at the end of the day, it probably doesn't make any difference whether they passed a temporary law or a permanent law. Because even by passing a permanent law, they aren't really going to cost the country the $20 trillion, because they'll change their position before most of those costs come due. Some of you, I'm sure, may be thinking in that way. And it turns out that that's actually not exactly right either. And that's illustrated down in Table 3. Well, Table 3 tries to compare are two different ways of enacting a piece of legislation. The first line is permanent legislation, and the second is temporary legislation. And here, what I'm assuming is that after year 10, Congress comes to its senses and says, my goodness, we can't afford this program. We've got to change. We've got to get rid of the program. And so what they do on line 1, having enacted a permanent program in year 1, is at the end of year 10, they simply repeal the program, okay? Whereas in line 2, having enacted a temporary program for 10 years, they simply let it expire, okay? So in either case, Congress accomplishes the same end, which is to say, we'll have the program only for 10 years, and then we realize we can't afford it, and so it's gone, right? Well, what are the budget implications of that? Well, as you can see on line 1, the official cost of a permanent program is estimated at, again, the $400 billion over the 10 years. But now, because the law was enacted as a permanent change of the law, it changes the baseline. The baseline now, forever on, assumes the existence of that law, because the law is permanently in the books. And therefore, when at the end of year 10, Congress comes along and changes its mind and says, by golly, we can't afford this law, we have to repeal it, then the estimated cost or the budgetary consequence of that, as shown by the next column, is actually a $400 billion cost savings as a result of that change. Because what now Congress has done is Congress has repealed a law that would have cost $400 billion over the next 10 years, and now Congress is pulling back and not going to spend that $400. And therefore, if you look to the far right-hand column, the net official costs, and obviously this kind of cuts through present value issues and all the rest. So, but you look at the far right-hand column, the net official cost over the 20 years turns out to be 0. This is a program that was in effect for 10 years and was providing $400 billion of benefits over 10 years, but the official budgetary cost of this is zero. Contrast, if you will, line 2, where you see the estimated cost of the first 10 years is the same, $400 billion. At the end of year 10, the temporary program is simply allowed to expire. That's perfectly consistent with the baseline, and therefore there is no effect in years 11 through 20 as a result of letting this temporary law expire, and therefore the net official cost over that 20-year period would be the $400 billion, the right amount, assuming there was no estimation error. In reality, this is exactly what's going on right now. I don't know how many of you are following, but Congress is gradually, and it's still early, but Congress is gradually waking up to the fact that it can't afford the Medicare drug legislation. And so there's now a proposal which isn't going to pass, but it is a proposal coming out of the administration and being considered this session to modify that law a little bit and essentially to take away some of the benefits for higher income senior citizens, and there's various ways that are done that. Those proposals, when they're proposed, are now going to be estimated as saving money. And what Congress does when it proposes ideas that purportedly save money is it then turns around and spends the same money that it's purportedly saving. And that's exactly what's going on in Medicare right now. There are certain Medicare programs that they want to expand. That's going to cost more money. And so now Congress is turning around and saying, well, let's just cut back a little on this prescription drug legislation, and that will, quote, save money, and that will offset the two. In short, an important threat to greater fiscal responsibility is the enactment of laws such as permanent legislation whose budget effect extends beyond the end of the budget window period. In that case, the official cost estimate of the legislation presented to Congress does not reflect the complete budgetary implications of the change in law. Congress, therefore, will be in a position of taking action without being able to make an accurate comparison from a budget standpoint of the cost of the choices before it. Moreover, the absence of complete information means that Congress can avoid being held accountable for its actions. In contrast, legislation whose budget effect expires no later than the end of the budget window does not present the same difficulty. Cost estimates of such legislation presented to Congress will reflect the complete budget impact, barring estimation error. Hence, at least from the perspective of facilitating responsible budget choices, temporary effect legislation should be encouraged, and permanent legislation should not be. Much more can be said about the budget consequences of temporary effect and permanent legislation. Maybe some of you will want to ask a question of me at the end of my talk. Let me, however, briefly turn to some non-budget related issues regarding this choice of legislation. There are a number of other issues potentially implicated by this choice, and I confess that I have not worked all of them out in my mind. Thomas Jefferson, for example, favored temporary laws and even a temporary constitution as a way to prevent the dead hand of past generations from controlling the rules of current and future ones. On the other hand, as Madison pointed out to him, and as I alluded to initially, there might be chaos if most laws were adopted on a short-term basis and continually changed. One point worth remembering is that there need not be such a dramatic difference between permanent and temporary legislation. The history of permanent tax laws in this country, for example, is one of very frequent change. By one account, there have been over 15,000 changes to the law since the last major reform in 1986. That's 2 changes every day since 1986. At the same time, temporary effect legislation could be enacted in a way to achieve considerable stability and predictability if Congress were to give priority to those attributes. For example, I have suggested that to enhance fiscal responsibility, there should be no budget effect of legislation beyond the end of the 10-year budget window period, the period the budget consequences of the legislation are taken into account in the legislative process. But there would be nothing to prevent a Congress within that constraint from extending an expiring law 10 years in advance of its scheduled expiration. By doing so, Congress could ensure stability and predictability in the laws for a 10-year period, a state of affairs that would compare favorably to our experience with many permanent laws. Another concern about temporary legislation is its economic effect. Economists generally agree that tax incentives are most effective if they are adopted on a permanent basis. A temporary incentive simply increases the risk of an investment and therefore the risk premium charged by the investor. In the worst case scenario, one could envision investors disregarding completely the possible effect of an expiring tax benefit because of its uncertain application. In that case, should the tax benefit end up being continued and available to the investor, it would constitute a pure windfall to the investor and not provide any worthwhile incentive effect. Of course, many tax provisions are not incentives at all, but are intended to accomplish some other purpose, such as income measurement, income support, or redistribution. Other provisions are intended as short-term incentives. For these, a temporary provision might be as effective or more effective than a permanent provision. Even if a provision is intended as a long-term incentive, passage of a temporary law may not be much different from enactment of a permanent one that is frequently changed. Investors learn from and take into account the frequency of tax law change in determining how risky a particular investment is. Indeed, it may be for this reason that the evidence has been very mixed on the effectiveness of past tax incentives. Finally, we should not forget one other important source of uncertainty for all investors, the concern that current fiscal policies are unsustainable. To the extent greater use of temporary effect legislation results in more responsible fiscal decision-making, the long-term budgetary situation should be improved with positive effects on the efficiency of all incentives. Let me discuss one final issue, the effect greater use of temporary laws might have on the costs of influencing legislative outcomes, including amounts paid to lobbyists and campaign contributions and other benefits provided to legislators. In an application of the interest group theory of the legislative process, two professors have contended that the recent repeal of the estate tax resulted from an effort by the members of Congress to maximize the returns received by them from the private sector. Key to their thesis was the passage of temporary legislation and the avoidance of possible permanent compromises in order to help string along the issue as long as possible. Thus, their study implies that the more temporary legislation that is passed, the greater the stringing along opportunities and the more costs that will be incurred to influence legislative outcomes. This position is related to one other concern expressed by Madison to Jefferson, that necessary reconsideration of expiring legislation would engender pernicious factions that would otherwise not come into existence. In very general terms, the interest group theory of the legislative process conceptualizes legislation as carrying out a transfer of benefits from one group, typically thought to be large, disorganized, and with diffuse interests, such as taxpayers generally, to some other group thought to be small, focused, and easily organized, such as persons or firms having some common special interest. Enactment of a tax provision benefiting only a small group and paid for by a slight increase in general tax rates would be a common example. Under this theory, the role of a legislator is somewhat analogous to that of a broker. Like a broker, a legislator is compensated for his actions in the form of campaign contributions and other benefits in an indirect way as a result of pairing up the two principals or groups and facilitating a transfer between them. Unlike a broker, however, the legislator actually creates the product or medium for carrying out the transfer by proposing and passing legislation. A legislator also does not merely serve as an intermediary between a willing buyer and a willing seller. Rather, the legislator forces the transfer upon an unwilling transferor for the benefit of a very willing transferee. The more a legislative product generated by a legislator, the greater the potential return received, with the process being initiated either by the transferee beneficiary or the legislator himself. Now suppose that under this model, a constitutional amendment were adopted, barring the enactment of permanent legislation. The amendment might provide that the duration of all laws, or an important subset of all laws, such as all tax legislation, could not extend beyond the budget window period. How would such a change affect the costs of influencing legislation? One consequence of the constitutional amendment would be a devaluing of the product potentially generated by legislators. The value of legislation is a function of many factors, but an important one is the duration of the law. It is for this reason that changes to the Constitution are generally viewed as having the greatest value, followed by permanent legislation and then temporary legislation. True, the long-term value of permanent legislation will be discounted to take into account the risk of subsequent amendment or repeal. Still, one would ordinarily expect permanent legislation to be more valuable than identical legislation that is scheduled to expire at some date certain. If the legislative product is less valuable, then the costs incurred to influence the shape and fate of that product should also be reduced. Under the interest group theory of the legislative process, the amount paid by a private sector group to favor or block a piece of legislation should be a function of the benefit or harm produced by the legislation to that group. If temporary legislation is less beneficial or harmful than permanent legislation, then the private sector payments should be less. There may be additional and possibly offsetting consequences to the constitutional amendment. Temporary legislation should be easier to pass than identical legislation that is permanent, perhaps because of its lower value. Thus, one supply-side effect of the constitutional amendment might be an increase in the amount of legislative product considered and passed by legislators, and this increased volume might offset to some extent the decrease in value of each individual legislative product. One constraint here, however, is legislative time. The amount private sector groups are willing to pay for to influence legislative outcomes is presumably a function of the credibility of the legislative effort, and that credibility may in turn depend upon the amount of time spent explaining and debating the product, whether in hearings, other committee deliberations, congressional floor action, or in meetings outside of the formal legislative process. Although one might expect temporary legislation to pass more quickly than identical permanent legislation, there clearly would be a limit to how much legislators could ratchet up their legislative activity to offset the devaluation of their product. Legislators might try to enhance the value of their product by changing some other dimension of legislation. For example, tax cuts might be made deeper or applied to a broader segment of people. But these possible changes, as well as the potential increase in the volume of legislation, would all be constrained by the budgetary consequences of the actions. As previously discussed, a switch to temporary effect legislation should reduce and possibly eliminate unaccounted for costs in the legislative process. This should mean that over time, under the hypothetical constitutional amendment, legislative choices should be more constrained by budgetary implications. Legislators, therefore, may not have much freedom to change the composition or amount of their legislative product. If the total amount of legislative product that could be generated by a legislature were fixed, then the constitutional amendment might have a favorable smoothing effect by ensuring that the fixed amount of production generates benefits over an extended period of time. For example, the passage of a temporary tax cut rather than a permanent one ensures greater private sector interest in the issue in the future when the legislature considers extending the temporary law. Thus, by approving a temporary rather than a permanent law, the legislature could be viewed as passing up receipt of some private sector benefits in the current session in exchange for a continuing a flow of such benefits in the future. This forced smoothing might turn out to be advantageous if, because of rules like campaign finance laws, there are limits placed on how much legislators can receive at one time from private sector groups. The problem with this argument, however, is that there is virtually no limit to the productive capacity of legislators within the overall constraints of legislative time and budget restrictions. Permanent changes to the law adopted in one session do not in any meaningful sense use up what a legislator can do in the next one. Different laws can be proposed and adopted, or existing ones can be modified or repealed, all on a permanent basis. Thus, there is no reason for a legislator to moderate his behavior in a given session except for time and budget restrictions, since there is virtually no limit to the total amount of what he can produce. This is particularly true given the existence of short-term election cycles. A legislator who passes up the receipt of benefits in a current session in order to ensure a continuing flow in the future may not survive long enough in the legislature to realize those benefits. One final possible strategy of legislators to enhance the amount of private sector benefits obtained might be to increase the use of so-called incomplete contracts, that is, threatened but ultimately unexecuted legislative actions. For examples, legislators might threaten to increase the taxes of certain persons, firms, or industries, and then eventually back off of their proposals in whole or in part. The recent flurry of proposals to increase the taxes of certain private equity and hedge fund managers, which has engendered a tremendous amount of lobbying and campaign contributions to legislators, may be one illustration. One advantage of this strategy is that depending upon what, if anything, is eventually enacted, there may be little or no budget effect to the legislative action, although legislative time will still be used. Thus, legislators might successfully increase their use of incomplete contracts even in a world of severe budget constraints. And indeed, the constraint itself might help to make the threatened action more credible. But even if this strategy were employed, it is not clear why legislators would prefer to threaten temporary as opposed to permanent action if the latter presents a more harmful outcome to the interested groups and therefore would generate a greater response from them in order to prevent the threatened action. In summary, under the interest group theory of the legislative process, greater use of temporary effect legislation should arguably reduce the costs incurred by the private sector to influence legislative outcomes. The reason is that the temporary nature of legislation reduces the value of the legislative product and therefore the amounts private sector groups would be willing to pay. There may be collateral and possibly offsetting supply-side consequences to more temporary effect legislation, such as an increase in the amount, scope, and magnitude of legislation, but these effects may be constrained by legislative time and budget considerations. In my talk, I have disagreed with the conventional wisdom regarding the budgetary impact of temporary legislation. Specifically, I have argued that greater use of temporary legislation should enhance fiscal responsibility. Instead, it is the adoption of permanent legislation that is the real threat from a budgetary standpoint. I have also touched on a few non-budget related issues and suggested that although temporary legislation may not be clearly more favorable than permanent legislation from these perspectives, it is also not clearly less favorable. There are, of course, other policy issues that would need to be considered in addition to the ones that I have mentioned. One final criticism I might anticipate is that the choice of temporary or permanent legislation only affects new laws adopted by Congress. Thus, any preference for temporary laws completely misses the real fiscal problem in this country, which is the budgetary impact of government programs already on the books that will soon provide benefits to the baby boomers as they begin to retire. This is a fair criticism, and a temporary effect preference should best be thought of as merely a useful first step in addressing the fiscal problem. It bears remembering, however, that the current fiscal difficulties are the result of permanent legislation enacted in the past. There may have been understandable reasons for the design of that legislation, so that, as one analyst has stated, it is a tragedy without villains. But it is a tragedy nevertheless. And it is a tragedy that, just maybe, could have been avoided if the initial legislative efforts had not been allowed to have permanent effects. Some of you may know that in Mexico last month, due to the controversy surrounding his election, the newly elected president of the country was allowed just 90 seconds to deliver the State of the Nation address to the national legislature. That's less time than it took Professor Adler to kindly introduce me just before my talk. This experience, however, reminds all speakers that the success of any talk is very much dependent on the reception and generosity of the audience. Thank you very much for your kind attention.
Please join us for a reception upstairs in Blackacre. For those of you that aren't familiar with it, that's basically up the stairs just outside the doors here to my right. Also, we have a small token of our appreciation for Professor Yin from the Center for Business Law and Regulation. There's actually a card holder inside. Thank you again for a very interesting, provocative talk. I'm sure Professor Yin will be happy to answer any questions any of you have at the reception. So please join me again in thanking Professor Yin, and please do join us upstairs.